Look closely at the chart on your screen right now. The Nasdaq 100, tracking through the massive QQQ exchange-traded fund, is trading at historic all-time highs. It is colliding aggressively with a very specific horizontal line sitting right around $720. To the untrained eye, this looks like a random peak. Most retail investors assume the market simply ran out of breath. They think it's just another resistance level drawn arbitrarily on a chart. But here's the fascinating secret: this exact price ceiling was not drawn today, nor was it a lucky guess. This structural wall was mathematically projected using a sequence of market data that began all the way back in October 2022, over 3.5 years ago. If you have ever felt like you are blindly guessing where a stock market rally will stall out, or where a massive market correction will finally hit rock bottom, you are completely missing the most powerful framework in technical analysis, the Fibonacci projection tool. In this video, we are going to pull back the curtain on the massive multi-year macro cycle that QQQ has been riding since that critical October 2022 bottom. We will analyze why the market is treating $720 like an absolute brick wall, explore the mathematical proof behind it using real Fibonacci extension levels, and then map out the next major extension milestone sitting right at $828. By the end of this video, you will understand exactly how professional traders and institutional algorithms identify these critical price targets months or even years in advance. Let's dive straight in. Before we can accurately forecast where a market rally is going to peak, we have to look back at history. This is a fundamental principle in technical analysis theory. To find out where an expansion wave will exhaust itself, you must first locate its exact point of birth. The starting point of any major rally becomes the foundation for projecting where that rally will eventually run out of momentum. When we zoom all the way out to a multi-decade perspective using a weekly logarithmic scale, the true structure of the market reveals itself. What you are looking at right now is the entire structural map of the secular technology bull market from the late 90s all the way into 2026. This is over 25 years of price history condensed into a single powerful visual. Notice how the market moves in nested cycles. Within this massive multi-decade uptrend, we experience fierce, multi-month cyclical corrections. These corrections are normal and healthy. They shake out weak hands, reset sentiment, and create the foundation for the next leg higher. The one critical reset that matters most for our current analysis occurred during the brutal bear market of 2022. Look at where my cursor is pointing right now on this chart. In October 2022, QQQ experienced a complete capitulation event, slamming into a generational floor at approximately $254. This was an incredibly painful moment for investors. Many thought the tech bubble had burst again. Fear was at extreme levels. But from a technical analysis perspective, that specific low is not just a historical data point. It is the absolute foundation stone of the current market cycle. It represents the baseline 0 point. Institutional trading algorithms, hedge funds, and automated execution systems anchor to this exact pivot point to measure the geometric expansion of the entire rally that followed. This is why October 2022 matters so much. Everything we are seeing in 2026 can be traced back mathematically to that foundational low. Now let me explain how the Fibonacci projection tool actually works. The Fibonacci projection tool calculates future target levels by measuring the price distance of an initial market wave and projecting those exact mathematical ratios upward from a chosen baseline. This is not guesswork. This is pure mathematics based on the Fibonacci sequence, which appears throughout nature, architecture, and financial markets. In this specific layout that you are seeing on screen, we need 3 points to construct the projection. Point number 1 is the low before the initial rally wave. Point number 2 is the peak of that initial rally wave. And point number 3, which is the most critical anchor, is positioned directly at the $254 floor from October 2022. By measuring the vertical distance between point 1 and point 2, we get what I call the original wave height. In this case, that wave measured approximately $287 in height. Now here is where the magic happens. By projecting this original $287 wave height upward from our baseline at point 3, the Fibonacci tool applies key mathematical ratios such as 127.2%, 161.8%, and 200% to map out clear, predictive rungs on a ladder. These lines extend directly into empty space, providing objective areas of hidden resistance where multi-year market cycles frequently consolidate, reverse, or exhaust their upward momentum. Think of these levels as invisible magnetic zones where price naturally wants to pause, rest, or reverse. Now watch how beautifully the live price action follows this geometric blueprint as it climbs the ladder. This is where theory meets reality. As the index broke out into new all-time highs in late 2024 and early 2025, it encountered its very first major extension milestone, the 127.2% level, sitting right around $614. Pay close attention to what the price did when it reached this line. QQQ did not blast straight through it like nothing was there. Instead, the price paused. It stalled out and chopped sideways for several months, forming a tight, dense consolidation base. This sideways movement is extremely significant because it allowed both the 50-day moving average and the 200-day moving average to catch up to the price, forming a massive cluster of support underneath. This behavior is textbook validation. It confirms that institutional orders were actively interacting with this exact mathematical level. Large institutions were taking profits, rebalancing portfolios, and waiting for confirmation before committing more capital. Retail traders who understand Fibonacci projections were also watching this level closely. Once the market digested that supply and absorbed all the selling pressure at $614, it used that line as a trampoline. The price launched into a vertical spike that landed precisely on the next major rung, the 161.8% extension at $720. This is what technical analysts refer to as the golden ratio expansion target. The 161.8% level, also known as the golden ratio or phi, is one of the most respected and widely watched Fibonacci levels in all of technical analysis. It appears everywhere in nature, from the spiral of a seashell to the proportions of the human body. In financial markets, the 161.8% extension acts as a powerful magnet for price. Because large institutional algorithms use this specific zone to systematically harvest profits, it naturally acts as a massive psychological supply wall. When millions of shares are being sold by algorithms all programmed to exit near the same mathematical level, you create enormous resistance. This is exactly what we are witnessing right now at $720. This brings us directly to the ultimate question: what happens next? If the index manages to break cleanly above the $720 ceiling, can we safely assume it is an easy, effortless cruise to the next target? Should we just buy with both hands and expect smooth sailing to $828? In the financial markets, no upward move is ever guaranteed or easy. Markets do not move in straight lines. However, our mathematical roadmap shows us exactly where the next major battlefield is located. If QQQ prints a definitive, high-volume close above the $720 mark, it enters price discovery mode once again. This means there is no historical overhead resistance because we are in completely uncharted territory. The next major target on our structural ladder is the 200% extension level, which sits with absolute precision at $828. This level represents a complete duplication of our original multi-year wave. Think about that for a moment. The distance from the October 2022 low to the first peak measured $287. If the market doubles that entire move from the baseline, we arrive mathematically at $828. But do not expect a straight vertical line to get there. Markets do not work that way. Typically, when a major index breaks a heavy resistance level like $720, it will trigger an initial breakout wave. This is the explosive move that gets everyone excited. Headlines will proclaim new all-time highs. Retail investors will rush in with FOMO, or fear of missing out. But then what almost always happens next is a sharp pullback. The market will retrace to retest the old $720 ceiling from above. This retest is absolutely critical. It needs to confirm that $720 has successfully flipped from resistance into a dependable support floor. If that retest holds, meaning the price bounces cleanly off $720 without breaking back below it, then we get confirmation that the breakout was real and not a false breakout or a bull trap. Only after that structural retest is satisfied does the market tend to build the real momentum required to complete the march toward $828. This process can take weeks or even months. Patience is absolutely essential. Professional traders understand this rhythm. Retail traders often get shaken out during the retest, thinking the breakout failed, only to watch in frustration as the market continues higher without them. Now let me be very clear about something important. Fibonacci levels are not magic crystal balls that dictate the future with 100% certainty. They do not guarantee that QQQ will hit exactly $720 in reverse, or that it will definitely reach $828 in the next rally phase. Markets are influenced by countless variables: economic data, Federal Reserve policy, corporate earnings, geopolitical events, and investor sentiment. However, what Fibonacci projections do provide is something incredibly valuable. They give retail traders the exact geometric coordinates where smart money, algorithmic programs, and institutional supply pools are waiting to interact. These are the zones where the big players are most likely to take action, whether that means taking profits, adding to positions, or reversing their stance entirely. Right now, as we speak, the Nasdaq 100 is testing the absolute limits of its current macro tier at $720. The price is bumping up against this level repeatedly, trying to find enough buying pressure to break through decisively. Volume is the key here. We need to see heavy volume on the breakout, not light volume. Light volume breakouts tend to fail quickly. So what should you do with this information? Are you looking to lock in profits here at the macro golden wall of $720, or are you holding out for a confirmed breakout toward the $828 extension milestone? This is the critical decision every investor needs to make based on their own risk tolerance, time horizon, and investment strategy. If you are a conservative investor, taking some profits near $720 makes perfect sense. You are selling into strength at a mathematically significant resistance level. If the market pulls back, you have cash to redeploy at lower prices. If it breaks higher, you still have remaining exposure to participate in further gains. If you are a more aggressive investor with a longer time horizon, you might choose to hold through this resistance level, knowing that if it breaks, the next target is $828. Just be prepared mentally and emotionally for potential volatility during the retest phase. For those of us who practice dollar cost averaging, like I do with my QQQ and QLD challenge, this analysis does not change our core strategy. We continue investing our fixed monthly amount regardless of short-term price action. But this Fibonacci framework helps us understand the bigger picture and keeps us from panicking during pullbacks. Let me know your precise market game plan in the comments below. Are you a seller at $720? Are you a buyer on any pullback? Are you holding and waiting for $828? If this step-by-step technical breakdown helped clarify your market perspective and gave you a better understanding of how professional traders use Fibonacci projections to identify major price targets, please hit the like button. Subscribe to the channel for continuous macro chart coverage and in-depth technical analysis. And turn on notifications so you never miss a structural update like this one. Remember, whether you trade actively or invest passively for the long term, understanding the mathematical structure of the market gives you a massive edge. You are no longer guessing. You are working with probabilities and geometric levels that have been tested and validated over decades of market history. Thank you for watching. Practice proper risk management, never invest more than you can afford to lose, and we will see you in the very next video. Stay disciplined, everyone.